Hi, I'm Joe Sillay with Federal National Commercial Credit. This is the second video in a series, the 10 most misunderstood cost drivers in factoring and asset-based lending pricing. This section is going to be about rates and fees. Now, factors and asset-based lenders operate very differently than a bank. They're not lending based on credit. They're actually doing a lot of work managing the collateral, managing the accounts receivable. And that's arms and legs work. That's people doing that work. So there's an added layer of cost with that. Very often, in most cases, these fees that you find in factoring proposals are designed to correspond to the costs that the factors have. So you'll have a prime plus function. And indeed, a factoring or asset-based lender looks at that component of the fees as an offset to their cost of borrowing. But at that point, they haven't made any money yet. So the other kinds of fees that are charged are often where a factoring company makes their money. The prime rate of borrowing in this country, I think most of us know, is considered to be the rate that banks charge their most valued customers for interest. So it's pretty low. It's for a big corporate borrower. And typically, those of us that are not big corporate borrowers pay prime plus something, the prime plus 1, prime plus 2, prime plus 3, whatever. This is an annual number. You may also see some proposals quoted at the LIBOR rate. LIBOR plus a number. Now, LIBOR stands for London Interbank Borrowing Rate, and because it's a concept of what big banks charge each other loaning money back and forth, it's even lower than prime, significantly lower than prime. So when you get a quote based on LIBOR, you're going to have a larger spread component. It won't be LIBOR plus 1 or 2, it'll be LIBOR plus 5, 6, 7 is more likely in the small business environment. I'd like to go through a little example, if we can here, about a prime function and how it typically works and how it's computed. Follow me if you would on this. So here's a slide running through an example of a typical prime plus component. Prime plus 2%. Today's prime's 3 1/4 in our like our example before. You add another 2%, we get to 5 1/4. Typically what happens is that annual rate is divided by a 360-day basis, and you come up with a daily rate that will accrue for each day. So an advance that you receive against your accounts receivable will be charged that daily rate for every day the advance is outstanding. But how that actually works, when you get credit for payment, when the charge starts, when it turns off, all of that can vary, and that can impact your cost. But typically, this is the way you get to a daily rate. You divide by 360. So let's sum up about factoring rates and fees. Usually, nearly always, in a factoring or asset-based agreement, there are more than one fee, or more than one type of charge. Usually, the servicing fees or the collateral management fees are more significant in their cost and effect than the interest component. A discussion you have with a factor or a proposal usually does not have enough information, give you enough information for you to be able to really know how those fees are going to work and what it's going to cost you. Only with a very careful review of a sample factoring agreement or a sample asset-based lending agreement can you really determine what those numbers mean, how they're going to operate, and how they're going to produce cost to you in exchange for service. One technique you may try on this is ask the factoring company to model the fees for you, to create a spreadsheet and show you for volumes and numbers of invoices and for the length of time they take to pay, model out for you what your actual costs in dollars and cents will be under their proposed agreement. That should illustrate very quickly for you how those fees are going to work and will help you come to an understanding. This has been the rates and fees video in our video series, the 10 most misunderstood cost drivers in factoring and asset-based lending pricing. Our next video is going to be about time and turn function. We're going to go into some actual calculations to show you how the length of time that your invoices take to pay costs more or less in different fee structures depending on how those fees operate. I'm Joe Sillay with Federal National Commercial Credit. Thanks for watching.